Usually when you look at a software company's financial report, you're looking at, well, an established set of physical laws.
Right. Gravity applies.
Exactly. Gravity applies. If a company wants to grow its revenue rapidly, it has to spend just a massive amount of cash up front on sales, on marketing, on, wining and dining clients.
You're essentially buying that growth.
You're buying it, yeah. And as a direct result, your profit margins take a heavy hit until those customers actually pay off, which could be years down the line. It's a familiar, very predictable seesaw of enterprise software.
Yeah, that's the classic SaaS business model, software as a service. You burn through capital to grow your footprint as aggressively as possible.
Right.
Because the entire thesis relies on the hope that once you embed your software into a client's operations, the switching costs become just, too high.
Too painful to leave.
Exactly. And they stick around long enough to eventually make that underlying relationship profitable. It's a known, honestly, somewhat tedious equation.
But then you encounter an earnings report that completely shatters that equation. It's like watching water flow uphill.
It really is.
So today we're looking at a company that is somehow accelerating its revenue growth to staggering levels while simultaneously printing record profits.
No, it shouldn't happen.
It shouldn't happen. And the kicker is they're pulling this off with a sales team that could basically fit in a minivan. So welcome to a brand new deep dive. Our mission today is to unpack Palantir Technologies' explosive Q1 2026 earnings report.
And we've got a really massive stack of sources for this one. We're synthesizing granular financial breakdowns from GoTrade and TradingView.
Great sources.
Yeah, and the tech sector reporting from SiliconANGLE, plus a highly detailed earnings call transcript via the Molly Fool. Oh, and a remarkably candid shareholder letter straight from Palantir's CEO.
Right. And if you've been following the YouTube finance AI community lately, you know this specific report has just been dominating the conversation. Everyone is talking about it.
It's everywhere.
So we want to figure out what this actually means for you. Whether you're an existing shareholder trying to understand the underlying mechanics of your investment, or, a potential investor wondering if this train has already left the station.
Because to be clear, this is not a standard earnings report.
Not at all.
This is a story about a company completely defying the traditional rules of software. Boasting an almost unheard of 85% revenue growth rate at scale.
But here's the tension, right? Despite these shattered metrics and a massive beat on expectations, the stock actually dipped slightly right after the news dropped.
Which confused a lot of people.
Yeah. So with a sky-high valuation and a market demanding absolute perfection,
right.
What is the real story here? Okay, let's unpack this.
Well, the scale of the financial beat is probably the best place to start, simply because the raw numbers are they're anomalous.
Lay them out for us.
We are talking about Q1 2026 revenue hitting $1.63 billion. That is an 85% jump year over year. Right. To see a company operating at a billion-plus quarterly run rate and still accelerating revenue at 85% is, it's incredibly rare.
It is, but the profitability metrics are what really grabbed my attention, honestly. GAAP net income hit $871 million.
Yeah.
That is more than 4 times what they reported in the exact same quarter last year. 4 times.
That's massive.
There's this specific statistic from the CEO's shareholder letter that just puts this into perspective perfectly. He pointed out that Palantir generated nearly as much pure profit in the single quarter as they did in their total top-line revenue just 12 months ago.
That is, a phase shift like that only happens when intense operational discipline meets a product architecture that just scales without friction.
Right.
You can actually see the evidence of that efficiency in their revenue per employee metric.
Oh, this is a fun one.
It currently sits at $1.5 million globally. And if you isolate just the U.S. workforce, it's $1.6 million per employee.
Which means every single person on Palantir's payroll is effectively generating over $1.5 million in revenue. That's absurd.
And the enterprise deal sizes backing that up are just massive. The earnings call transcript via Motley Fool noted they closed 206 deals worth at least $1 million in the quarter.
Right, and 47 of those were mega deals, like over $10 million each.
Exactly. And the most revealing way to contextualize all of this, for anyone looking at the software sector, is through the rule of 40.
Okay, let's break that down, because not everyone might know what that is.
Right. So for anyone analyzing software as a service or SaaS metrics, the rule of 40 is sort of the ultimate benchmark for health. You take a company's revenue growth rate percentage and you add its profit margin percentage.
Just simple addition.
Simple addition. And the reason 40 is the gold standard is because software is notoriously hard to implement. Sales cycles take forever, integration is messy, and customization requires, incredibly expensive engineering hours.
So it's a balancing act.
Yes. If your growth and profit margins add up to 40, you are considered an elite software company. You're balancing expansion with efficiency.
Okay, so 40 is elite. What was Palantir's score?
Palantir's score for this quarter is a staggering 145.
145. That breaks the scale entirely.
As the CEO noted in his letter, it's an anomaly. I mean, a score of 145 is typically reserved for hardware and infrastructure giants.
Like who?
Companies like NVIDIA, Micron, or SK Hynix. Companies that manufacture a physical component that the entire world is desperate to buy and nobody else can make.
Right, the chip makers.
Exactly. To see a software company score a 145 means they're growing at 85% while operating at margins that shouldn't mathematically exist in this sector.
Well, okay, I have to point out a detail from the earnings call that makes those numbers sound even more bizarre.
Oh, the sales team stat.
Yes, Palantir only has about 70 salespeople globally.
It's wild.
And the CEO openly claimed that out of those 70, only 7 of them actually even really sell.
Yes, 7 people driving that growth.
I'm trying to wrap my head around this. How on earth is a company doubling its U.S. revenue and closing nearly 50 $10 million deals with a sales team that tiny?
Well, the only logical conclusion is that the product is completely bypassing the traditional enterprise procurement process.
It has to be.
Right. If you aren't relying on an army of account executives taking chief information officers out to expensive steak dinners to slowly convince them to buy a license.
Which is how it usually works.
Exactly. If you're not doing that, the software must be demonstrating undeniable, immediate value the second it gets turned on.
And the product we're talking about here is AIP, their artificial intelligence platform.
Yeah, AIP. And the TradingView data highlights a very telling metric regarding AIP. They report a customer acquisition cost, or CAC, payback period, of just 5.3 months.
Okay, CAC payback. That measures exactly how long it takes for the profit from a new customer to cover the marketing and sales dollars spent to acquire them.
Right, you got it. And in complex enterprise software, a normal payback period is often 18 to 24 months.
Wow, so 1.5 to 2 years just to break even on the sale.
Yeah, sometimes just the pilot program and the data integration phase takes 6 to 9 months alone. So Palantir recouping those costs in 5.3 months proves they aren't spending a year integrating the software.
They just plug it in.
They deploy it, the customer sees an immediate return on investment, and they aggressively expand their usage in less than half a year.
So if the software is being adopted that fast without a traditional sales engine, something fundamental has changed in the market demand.
Oh, absolutely.
And our sources point to a dynamic that Palantir's CTO calls Jevons paradox. And here's where it gets really interesting, because it explains the underlying economic force driving this hypergrowth.
Yeah, Jevons paradox is an economic concept. It actually dates back to the 19th century.
The steam engine era.
Right. When Victorian engineers made steam engines significantly more efficient, the general assumption was that overall coal consumption would drop because, factories needed less coal to perform the same amount of work.
Makes sense on paper.
But the exact opposite happened. Coal consumption skyrocketed. Because cheaper, more efficient power meant people found exponentially more ways to utilize steam engines.
It opened up new use cases.
Exactly. And the CTO applies this directly to the current state of artificial intelligence. Since early 2023, the cost of AI tokens has dropped by roughly 1,000 times.
1,000 times cheaper. I love this concept. It's like when digital data storage got incredibly cheap.
Oh, that's a good comparison.
Right. We didn't stop buying hard drives to save money. We just started taking 1,000 photos of our lunch.
Exactly.
We didn't reduce our spending. We just consumed infinitely more data because the friction was gone.
And that's exactly what's happening with AI. The CTO argues that because inference, which is the actual computing power required to generate an AI response, is practically free now, the demand to use AI for every conceivable enterprise task is exploding.
Everyone wants AI in everything.
They want to use it for everything from writing emails to managing global supply chains. But that explosion in demand creates a massive vulnerability.
Because more tokens usually equal more of what Palantir calls AI slop.
Yes, AI slop.
Slop is a great word for it. It just implies a mess.
It is a mess. When you let generic large language models loose on your proprietary enterprise data without strict architectural guardrails, you get unreliable, hallucinated outputs.
Right. The AI just makes things up.
Yeah, you get an AI confidently generating a report for your CFO with fabricated financial metrics. Or, maybe worse, an AI inadvertently summarizing and exposing highly classified HR data to a junior intern.
Oh, that's a nightmare scenario.
As the cost of AI drops to zero, the volume of dangerous slop inside corporations goes through the roof.
Okay, so Palantir positions AIP as the solution to this, right? The no-slop zone. And they say they do this using an ontology.
Right, the ontology.
Which sounds great in a marketing pitch, forcing the AI to check its work. But I'm struggling to picture what that actually looks like for the end user pressing the buttons. How does an ontology prevent the slop?
Okay, think of the ontology as a rigid structural layer of reality that sits between the AI model and the company's data.
Okay.
It's essentially a digital twin of the business. It defines exactly what objects exist, how they relate to each other, and who is allowed to touch them.
So it's like a rule book.
A very strict rule book. Before the AI can execute a command or generate an answer, it is forced to cross-reference its logic against this strict set of factual rules and permissions.
It can't just guess.
No guessing allowed. It transforms the AI from a creative text generator into a deterministic, auditable software engine. Every action is governed. You know exactly what the AI did, why it did it, the specific data it referenced, and who authorized it.
Okay, if the software is actually eliminating that slop and providing that level of certainty, it starts to make sense why the adoption is so aggressive.
Oh, yeah. Look at the ShipOS example from the U.S. Department of the Navy that SiliconANGLE detailed in their reporting.
Right, I saw that.
By deploying Palantir software, the Navy took a critical manufacturing bill of materials approval process that used to require 200 hours of manual review.
200 hours?
And they reduced it to 15 seconds.
Wow. Wait, 200 hours down to 15 seconds.
15 seconds.
Dropping a process like that isn't just an incremental operational improvement. That is a complete paradigm shift in how an organization functions.
Exactly. They also increased the speed of contract review cycles by up to 73% and cut monthly material planning time by 94%.
And we see the exact same architectural approach on the commercial side, too. AIG, the massive global insurance company, they're using AIP to deploy multi-agentic AI for their underwriting process.
Yes, the multi-agentic AI.
Let's clarify that term, multi-agentic AI, because that sounds like another dense technical concept.
It sounds complicated, but it's pretty straightforward. In a multi-agentic system, you aren't just asking one AI chatbot a question. You have multiple distinct AI models that actually collaborate.
Like a team of robots.
Yeah, they collaborate, they challenge each other, and they hand off specialized tasks. So for AIG, they have different AI agents ingesting client submissions, evaluating the risk profiles, benchmarking the market pricing, and actively detecting fraud patterns.
All working at the same time.
All working together. And all those agents are coordinated securely through Palantir's ontology layer to ensure they don't hallucinate the underwriting terms.
So they're fundamentally rebuilding the core load-bearing operational engines of these institutions.
That's exactly what they're doing.
Which leads us perfectly into the dual engine of their business model. Because if you look at where this technology is being applied, the U.S. revenue growth numbers are staggering.
The U.S. market is overwhelmingly the primary growth driver right now. U.S. commercial revenue grew 133%.
Wow.
And the CFO clarified on the earnings call that if you exclude a specific program that transitioned over from the commercial side to the government side, that underlying U.S. commercial growth would actually be 143%.
That is massive, and the government side is accelerating right alongside it.
Yeah.
U.S. government revenue hit $687 million, which is an 84% growth rate.
Yeah, and we're seeing massive adoption directly on the battlefield.
Right, the Maven Smart system.
Exactly. Usage of their defense-focused Maven Smart system has quadrupled over the last 12 months alone. It's being deployed heavily across combatant commands and the broader intelligence community.
And the expansion isn't limited to just the Department of Defense either. The reporting highlights a massive new contract awarded in April by the USDA, the Department of Agriculture.
That was a huge win.
Yeah, that contract has a ceiling of up to $300 million. And the goal is to deploy Palantir software to help secure American farmland, enhance agricultural supply chain resilience, and actively prevent fraud in complex subsidy programs.
And there's a very deliberate cultural stance behind all of this government growth. The CEO is fiercely unapologetic about it in his letter and on the earnings call.
Very vocal about it.
He explicitly states that Palantir will always prioritize U.S. national security and the American warfighter above any commercial client and above any other corporate variable.
Completely dedicated to the defense sector.
Yes.
But I have to ask, from a business perspective, does a hospital network or a logistics company really care about battlefield software? How does prioritizing the military actually help sell software to massive commercial corporations.
Well, counterintuitively, that monogamous dedication to U.S. defense is actually the ultimate commercial marketing tool.
Really? How so?
It all comes back to the fear of AI slop that we were just talking about.
Right, the hallucinations.
Yeah. If a corporate chief information officer is terrified of an AI model hallucinating and ruining their business operations, or a data breach exposing their proprietary secrets.
They want something safe.
Exactly. What is the strongest possible reassurance you can offer them? You don't offer them a slick Silicon Valley marketing video. You tell them the software you are about to install to run your supply chain is the exact same underlying battle-tested platform that the U.S. military trusts to run real-time targeting and secure communications in active war zones.
Ah, I see. The rigorousness is the selling point. If the architecture is secure enough and reliable enough for the Department of Defense to literally bet lives on, it is certainly secure enough to handle your corporate accounting data.
Exactly. Corporate clients recognize that they're buying deeply reliable, hardened software. It creates an enormous moat that completely separates Palantir from, a standard startup offering a thin AI wrapper that might suffer a catastrophic data leak next Tuesday.
Right, they're in a different league entirely. So, what does this all mean for you, the listener, staring at your investment portfolio?
The big question.
Right. We've covered the fact that the execution seems flawless. The product is bypassing traditional sales bottlenecks, the growth metrics are explosive, and the margins are defying software economics.
Yeah.
But despite all of this, despite crushing the Wall Street estimates and raising their full-year revenue guidance to over $7.65 billion, the stock still sagged about 2% immediately following the report.
It did.
If I'm looking at a company performing this well, how do I justify a stock drop? Well, the drop is entirely a function of the valuation multiple, which is the ultimate dilemma in the current market. Can you safely invest in an asset that is already priced for absolute, unyielding perfection?
Because it's priced very high right now.
Palantir currently trades at a forward price-to-earnings ratio near 110x.
110x.
And the GotTrade analysis points out that depending on how aggressive your discount rates are for future earning streams, some models put that multiple closer to 150x.
Wow. To put 110x forward PE into context, the sources compare it to other massive players powering the tech sector.
Right.
Like NVIDIA.
Right, NVIDIA.
NVIDIA is essentially manufacturing the physical infrastructure for the entire AI revolution, and they trade around 30x forward earnings.
30x versus 110x.
Datadog is hovering in the mid-50s. CrowdStrike is in the mid-70s. Palantir's valuation is towering over almost every comparable company in the market.
It is. And when a company is priced at 110 times its forward earnings, the market isn't just assuming success. The market is mathematically demanding that the company executes flawlessly for the next decade.
Perfection is priced in. There is zero margin for error built into that price. And the algorithms, the institutional trading algorithms, they actually found a tiny margin of error in this report.
Oh, the soft spot.
Yeah, the single soft spot identified was that U.S. commercial revenue, despite growing 133% to $595 million, technically missed the Wall Street Whisper number by roughly $10 million.
Wait. They miss a totally unofficial back-channel whisper expectation by $10 million on a $1.6 billion quarter, and that triggers a sell-off.
That's all it takes.
Are investors basically buying a ticket on a rocket ship where if a single bolt rattles during launch, everybody panics and hits the eject button?
Yes. The psychology of a hyper-growth stock dictates exactly that kind of hair-trigger reaction.
Wow.
And the GoTrade framework highlights another structural reality that adds to that fragility, which is customer concentration.
Right.
Palantir only has 1,007 commercial customers in total. While that metric is growing nicely, it is still a very small absolute number compared to a giant like Salesforce or Microsoft.
So they're top-heavy.
Very. Losing just one massive civil government contract or a handful of large commercial accounts would move their top-line revenue meaningfully.
If the air's that thin up there, how do you manage the risk? The GotTrade analysis actually provides a really solid way to think about this without getting emotional about the technology.
What's their framework?
First, they suggest looking at your portfolio size. If Palantir has gone on a massive run and now makes up more than 10% of your equity book, it might be prudent to trim the position to manage concentration risk, regardless of how much you love the company's mission.
That's just smart portfolio management. And time horizon is the next critical filter, right?
Yeah.
If you are taking a 5 to 10 year view, you can probably endure the inevitable short-term multiple compressions. The AI integration thesis is a multi-year story, and Palantir's moats in both defense and commercial sectors are incredibly deep.
But if you're short-term,
But if you're a short-term trader looking at a 1 to 3 month window, you have to respect the gravity of a 110x valuation.
and lastly, defining your bear case triggers before things go wrong. GowTrade suggests closely watching two specific metrics in the coming quarters.
Okay, what are they?
If U.S. government revenue growth drops below 50%, or if U.S. commercial customer growth falls below 100%, those are structural signals that the hypergrowth phase is decelerating and the premium valuation is no longer justified.
Exactly. So the fundamentals are pristine, but the price tag requires an iron stomach for volatility.
For sure.
But, regarding that deep technical moat we discussed, there's one final, incredibly provocative thought buried in the earnings transcript that really reframes Palantir's potential ceiling.
Oh, I know what you're talking about.
The CTO described a dynamic playing out right now that he calls a Sputnik moment in the global cybersecurity arms race.
A Sputnik moment. That implies a sudden, undeniable realization that your adversary possesses a technological dominance you didn't even know was possible. What is Palantir's AI doing to trigger that kind of realization?
It revolves around vulnerability discovery. Palantir's AI platform is now capable of autonomously discovering thousands of novel zero-day vulnerabilities across major operating systems and web browsers.
0 days, let me just clarify that. A 0 day is a critical software flaw that the original creators of the software don't even know exists yet, meaning there is zero time to patch it before it can be exploited.
Right. It's the holy grail for hackers.
So their AI is essentially finding the microscopic cracks in the foundation of the internet faster than any team of human hackers ever could.
And the CTO points out the terrifying implication of this. Because AI makes discovery practically free, the rate of unearthing these critical vulnerabilities globally is about to skyrocket.
Oh, wow.
Finding the bugs is no longer the hard part. Autonomous AI agents will do that constantly. The new monumental challenge is rapid-fire remediation.
Fixing them.
Organizations will desperately need a system that knows exactly what software is running where across their entire global enterprise and can patch those vulnerabilities with absolute certainty the second they are discovered.
Which means the more AI code the world writes and the more automated these systems become, the more attack surfaces are created.
Exactly. And the more desperately the world will need a platform like Palantir's Apollo to manage, update, and defend that infinitely expanding infrastructure.
That's a massive market.
So the question to ponder really is this. Does the real future value of Palantir lie not just in optimizing corporate supply chains or providing targeting software to the military,
Right.
but in becoming the absolute required immune system for the entire digital world?
Wow. If they actually become the foundational immune system of the internet, well, that completely changes the math on that 110x valuation.
It really does.
We started this deep dive talking about the established laws of physics and software, the predictable seesaw of growth versus profitability.
Yeah, the old rules.
Palantir isn't just breaking that seesaw. They are actively building an entirely new playground with their own set of physics. And whether you decide to buy a ticket to play or you prefer to just watch from the sidelines, you have to admit, it is absolutely fascinating to watch gravity get defied in real time.
It's going to be wild to watch.
Thank you for joining us on this deep dive into the Palantir earnings. Keep questioning the consensus and keep exploring.